This is FedWatch on Zacks.com. The Federal Open Market Committee has released another decision on interest rates. Well, in a historic move, the Fed has lowered the Fed funds rate by 0.75% to a record low 0.25%. At the same time, they released a statement signaling an aggressive posture. Here now with more on this is Charles Rotblut, our senior market analyst at Zacks.com. They've established a target range here in the course of all of this action as well for the Fed funds of 0 to 0.25%. So market reaction basically happy. Stocks and bonds higher on the news. Is this all just a psychological action, though?
Well, it's interesting. It is a psychological action by the Fed in terms of cutting rates, but the reaction from the markets is a little bit interesting because Fed fund futures, you can actually see them on the Cleveland Fed's website. Over the past 7 days, a very large spike in expectations for 50 basis points. So really, and even today, most of the commentators on TV, Bloomberg, CNBC, what have you, even on NPR, were saying 50 basis points. The Fed instead came out and said 0 to 25. So this is a bit of a surprise. Now, I should add the caveat that when you looked at the Fed fund futures, a little bit more weight to 25 over 50, so not a complete surprise, but generally we get an absolute number, 1%, 2%, 3.5%. A range is actually a little bit unusual, but what it does signal is that the Fed really realizes that the policy of cutting interest rates has not worked, and something else is needed. So now we're at the point where, really, if you go from 0.25 to 0, well, it's kind of meaningless. But to get people to understand what's going on, the Fed funds rate is really the rate that banks lend each other. It's overnight lending rate. And a good analogy is if you and I went out to lunch.
Buy, by the way.
I buy, but all of a sudden I say, Terry, I forgot my wallet at home. Can I borrow $10?
Sure.
You might loan me $10. The general expectation is that I'll pay you back quickly and that there's not going to be any interest rate charged to me. So what 0% discount rate means, basically, Bank of America goes to Citigroup, hey, can you loan me $1 million tonight? Citigroup lends it. The expectation is that now that Citigroup will get paid back the $1 million next day or two, and the interest rate might be 0, or you might be talking 0.25 basis point at $1 million, which I think, off the top of my head, would be about $25,000.
Okay.
Pocket change to a bank. Obviously, a little bit more than pocket change to you or me, but basically it means there's no charge for banks lending to each other, which raises the bigger question as to, well, why are my credit card rates suddenly being revised upwards? And that's why you see the other part of the Fed statement, which you talked about briefly, is that they're going out into the markets to try and actually attack those longer-term rates, because that's the real problem right now. That and the fact that lenders just don't trust borrowers.
Yeah, and they've kind of pulled out all the stops here. They have signaled that something else is needed because they're getting to the bottom end here now. There's not much more wiggle room with lowering interest rates. And so Ben Bernanke has said in the recent past that one of the tools that he's going to pull out of his trick bag is going to be what's called quantitative easing, which means just flooding the system with money for those people who don't understand that. Is that a good thing?
Well, it's a necessary thing. And I think the big thing that people have to understand throughout this credit crisis, it really comes down to lenders not trusting borrowers. And I know people who watch me regularly probably think I sound like a broken record, but that's really the big thing. Because really what we're seeing right now is a disconnect. We're seeing the Fed fund rates continue to be cut, but we're not seeing it with the long-term interest rates. Yes, we've seen mortgage rates pull back a little bit. We've seen improvement in the spreads. But at the end of the day, it's very difficult for people to get financing. And that hurts a lot of companies, not just the financial companies, not just home builders that we think of like D.R. Horton, but if you look across the board, companies like National Oilwell Varco, when you look at J.D. Nordstrom, IBM, we can go on and on. It really impacts economic spending and how quickly the economy can grow. And when you limit the ability of the economy to grow, that hurts companies across the board. So what the Fed's really looking at right now is, A, how do we get lenders to start trusting borrowers? And B, how do we get liquidity in the system? How do we get rates lower? How do we get more money flowing through the system? One of the things the Fed's actually looking at is going out, buying treasuries, buying agency debt, buying mortgage-backed securities. The whole idea is maybe they start buying these securities, will bring down interest rates, will get free up lending. Now, obviously, long-term inflation is going to be a huge problem. We talked about that on Monday, December 15th, about how we think the long-term outlook for commodities is bright. I really think it is. But over the short term, really low interest rates. And if you really see interest rates continue to crack more and you have a good got good credit, you may want to seriously consider refinancing your house, refinancing your car loan, looking for better credit card interest rates, because there is definitely going to be a historic opportunity for a lot of people to refinance at some point, hopefully over the next few months. Timing, of course, is very uncertain. Nobody knows how long the current recession or how long the current credit crunch is going to last, but the Fed is trying to do everything within its power to try and correct the current problems.
So the Fed says that while the economy is in danger of getting weaker, the risk of inflation has decreased appreciably. Did I hear that you don't agree with that?
Short term, the risk of inflation is pretty much close to nil. The Fed's trying to avoid a Japan situation where they do everything and nothing happens. Long term, however, I think we are going to be in a situation where inflation comes back, and it's going to be very tough inflation. We're not looking at inflation occurring by May, for instance, but if you start looking at a few years from now, all the signs, you got massive federal deficits, you got these historically low interest rates, you're looking at peak oil, we're basically running out of oil, growing world population, growing world economy, so you're looking at increased competition for commodities. All that combined is not going to help inflation over the long term. It's really going to it's not going to help keep inflation in check over the long term. It's really going to drive inflation higher. So long-term inflation is a problem. Short-term, it's not a problem. The bigger problem is the slowing economy, and the Fed's right to ignore the longer-term war and really focus on the immediate battle, which is trying to get the economy jump-started and get America and the world economy moving in the right direction.
Many people out there fear that cutting interest rates back as we have been, as aggressively as we have been, doesn't bode well for the dollar long term. What do you think?
It does not at all. And certainly there's a lot of things that we have to fix long term in terms of the dollar. Our trade deficit, our federal deficit, Social Security, healthcare, all that will impact the dollar. All that's longer term situations. And the good thing is Barack's actually assembled a cabinet that understands this is a long term problem. But right now, getting people back employed, getting lenders trusting borrowers is really the immediate problem, and it's a far bigger problem over the short term than worrying about the long-term consequences of the dollar. It's something that we will have to address, but not right now.
Does this lay a better foundation for the markets to look ahead now?
Not really. We still have no visibility, and I think anybody who claims to have visibility in the second half of 2009 is just kidding themselves.
All right, but you called the move. You said 3/4. You said it on the round table. I know. I hear these things. Can't put these things past me very easily. Once again, the Fed has lowered its Fed funds rate today in a unanimous vote to 0.25%. With Charles Rotblut, I'm Terry Ruffalo.